Warren Buffett, often called the world's greatest investor, has a surprising recommendation for most people: put your money in index funds and walk away. Why would someone with his expertise suggest such a simple, hands-off approach? In this video, we'll explore exactly why Buffett believes this is the smartest move for beginners and seasoned investors alike. By the end, you'll know what index funds are, why they consistently outperform most professionals, and how you can start investing in them today. Let's dive in and unlock the lazy way to build wealth. Index fund is a collection of stocks that mirrors a market index, such as the S&P 500, which includes the 500 largest U.S. companies. Instead of picking individual stocks, you buy tiny pieces of all 500 at once. This means your investment grows as the market grows, and historically the market has always increased in value over the long term. Index funds make it easy to diversify without the stress of choosing winners and losers. You're essentially buying a slice of the entire market, letting you benefit from overall economic growth. You invest in an index fund, you're not betting on a single company. Instead, you're spreading your money across hundreds of companies. This reduces risk and increases your chances of steady growth. If one company struggles, others in the fund can balance it out. Over time, the market's upward trend means your investment grows with it. Index funds are designed to follow the market, so you don't need to worry about picking the next big winner. It's a simple, effective way to build wealth. Over a 10-year period, more than 90% of actively managed funds fail to outperform the S&P 500 index. The main reason? Fees. Actively managed funds charge 1–2% per year, while index funds can charge as little as 0.03%. These fees may seem small, but over decades they compound against you, eating away at your returns. Index funds keep costs low, letting your money work for you instead of paying high fees to fund managers. This is why Buffett and many experts recommend index funds for most investors. Let's look at the impact of fees. Imagine you invest $10,000 for 30 years. With a 2% annual fee, you lose a huge chunk of your returns compared to 0.03% fee. The difference can be tens of thousands of dollars. Fees compound just like interest, but in reverse, they take away from your growth. Choosing index funds with low fees means more money stays in your pocket, helping you reach your financial goals faster. This is a key reason why index funds are so powerful for long-term wealth building. There are three main types of funds: index funds, ETFs, and mutual funds. Index funds and ETFs both track an index, but ETFs trade like stocks throughout the day. Mutual funds are actively managed by humans and usually come with higher fees. For beginners, an S&P 500 index fund or ETF is the best starting point. They offer low fees, easy access, and reliable performance. Understanding these differences helps you choose the right investment for your needs and avoid unnecessary costs. For beginners, starting with an S&P 500 index fund or ETF is a smart move. Popular options include VOO from Vanguard, FXAIX from Fidelity, and SPY, available on most platforms. These funds have extremely low fees and track the performance of the largest U.S. companies. You don't need a lot of money to start. Fractional investing lets you buy as little as $1. This makes index funds accessible to everyone, regardless of your budget or experience. You don't need thousands of dollars to begin investing in index funds. Thanks to fractional investing, you can start with as little as $1. This removes the barrier for beginners and makes it easy to dip your toes into the world of investing. The most popular beginner fund is VOO, Vanguard's S&P 500 ETF, with a 0.03% expense ratio. Other options include FXAIX on Fidelity and SPY on any major platform. No matter your budget, you can start building wealth today. First step to buying your first index fund is opening a free brokerage account. Popular choices include Fidelity, Vanguard, and Schwab. These platforms are user-friendly and offer a wide range of investment options. Setting up your account is quick and easy, and you'll be ready to start investing in just a few minutes. This is your gateway to the world of index funds and long-term wealth building. Once your brokerage account is open, the next step is to deposit money. You can transfer funds from your bank account, and most platforms make this process simple and secure. Even a small deposit is enough to get started, thanks to fractional investing. This step is crucial. Without funding your account, you can't invest. Take your time and make sure your money is ready to go. With money in your account, it's time to search for index funds. Look for VOO or FXAIX. These are popular S&P 500 options. Most brokerages have a search bar where you can type in the fund's ticker symbol. Once you find the fund, review its details and make sure it matches your goals. This step helps you find the right investment for your needs. Now you're ready to buy your first index fund. Thanks to fractional shares, you can purchase any amount, even just $1. Select the fund, choose how much you want to invest, and confirm your purchase. The process is straightforward and takes only a few clicks. You're officially an investor, and your journey to building wealth has begun. Maximize your returns. Set up automatic monthly purchases. Most brokerages let you schedule recurring investments, so you don't have to remember each month. This strategy, known as dollar cost averaging, helps you build wealth steadily and reduces the impact of market ups and downs. Automating your investments is one of the easiest ways to stay consistent and grow your portfolio over time. Index funds are designed for long-term growth. By consistently investing and letting your money compound, you can build significant wealth over decades. The market's historical upward trend means your investments are likely to grow, even if there are short-term ups and downs. Patience and consistency are key. Stick with your plan and you'll see results. Many beginners make mistakes like trying to time the market or chasing hot stocks. Index funds help you avoid these pitfalls by focusing on steady, diversified growth. Don't panic during market downturns. Stick with your plan and keep investing. Remember, the goal is long-term wealth, not quick wins. Avoiding common mistakes is crucial for financial success. Warren Buffett's endorsement of index funds isn't just a passing comment, it's based on decades of evidence. He knows that most people don't have the time or expertise to pick individual stocks. Index funds offer a simple, effective solution that beats most professionals. Buffett's advice is clear: invest in index funds, automate your contributions, and let your money grow. Passive investing means putting your money in index funds and letting the market do the work. You don't need to actively manage your portfolio or chase trends. This approach saves time, reduces stress, and delivers reliable results. Passive investing is perfect for beginners who want to build wealth without constant effort. Dollar cost averaging is a strategy where you invest a fixed amount regularly, regardless of market conditions. This reduces the risk of buying at the wrong time and helps you build wealth steadily. By automating your investments, you take advantage of this powerful technique without having to worry about market timing. If you're just starting out, focus on funds like VOO, FXAIX, and SPY. These track the S&P 500 and offer low fees, easy access, and strong performance. They're widely available and trusted by millions of investors. Choosing the right fund is important, but sticking with your plan matters even more. Start simple and grow your portfolio over time. Key to building wealth with index funds is consistency. Invest regularly, automate your contributions, and let your money compound. Over years and decades, small investments can grow into large sums. Index funds make it easy to stay on track and reach your financial goals. Remember, wealth building is a marathon, not a sprint. Now you understand what index funds are, why they outperform most professionals, and how to buy your first one. The lazy way to build wealth is simple: invest in index funds, automate your contributions, and stay consistent. Take your first step today and start your journey toward financial freedom. See you in the next video.